A few years ago, if someone had asked me for the simplest way to start investing, my answer would have been almost automatic. Buy a low-cost fund that tracks the S&P 500. Leave it alone. Keep investing consistently. For most people, I still think that's excellent advice. But over the past year, I've started changing how I invest. Not because I suddenly believe the stock market is about to collapse, and not because I think artificial intelligence is a bad investment. I'm changing because one hidden risk has quietly become much larger than most people realize. And once you see it, it's difficult to ignore. Tom discovered this almost by accident. Like millions of investors, he had built his portfolio around one simple idea. Every month, he bought shares of an S&P 500 index fund. He didn't try to predict the market. He didn't chase hot stocks. He simply followed the strategy that countless financial experts recommend. It felt safe. After all, how risky could an investment be if it owned more than 500 companies? That question led him somewhere he never expected. Here's the surprising part. Owning hundreds of companies doesn't always mean your investment is as diversified as it appears. And understanding why completely changed how Tom and eventually I thought about building a portfolio. Before we go any further, let's be clear about something. This isn't a video arguing against the S&P 500. Far from it. Over many decades, the index has delivered roughly 10% annualized returns before inflation, making it one of the most successful long-term investments available. Those returns weren't guaranteed, and they certainly didn't arrive smoothly. But history shows why millions of investors continue to trust it. So if the long-term track record is so strong, why rethink anything? Because investing isn't just about returns. It's also about understanding where those returns come from. That distinction matters more today than it has in a long time. Let's quickly revisit how the S&P 500 actually works. Many people imagine their money being divided equally across every company in the index. That's understandable. 500 companies sounds incredibly diversified. But that's not how the index is built. Instead, it's market cap weighted. In simple terms, larger companies receive larger positions. The bigger the company becomes, the bigger its influence on the index. That design has worked extremely well over long periods because successful companies naturally become a larger part of the portfolio while weaker companies gradually shrink. It's elegant. It's efficient. And historically, it's been incredibly effective. But it also creates something many investors rarely think about. Imagine two classrooms. One has 500 students where everyone gets exactly one vote. The other also has 500 students, but 7 students control a huge share of the voting power. Technically, both classrooms have 500 people. Practically, they operate very differently. The S&P 500 works in a similar way. The largest companies have a much greater impact on your returns than the hundreds of smaller companies beneath them. That isn't a flaw. It's simply how the index is designed. Now here's where Tom became curious. He opened the list of the index's largest holdings. Company after company looked familiar. The world's biggest technology businesses, businesses developing artificial intelligence, businesses building cloud infrastructure, businesses designing advanced computer chips, businesses investing billions into the next generation of AI systems. Suddenly, something clicked. Without intentionally making a bet on artificial intelligence, he already had significant exposure to companies leading that race. That realization raised a simple question. If so much of the index's recent success comes from a relatively small group of companies pursuing the same technological revolution, what happens if that story changes? Notice what I'm not saying. I'm not saying AI will fail. In fact, I think artificial intelligence is likely to reshape industries in ways we're only beginning to understand. Major companies are investing enormous amounts into data centers, computing infrastructure, and AI development because they believe the opportunity is real. They may be right. Some of those investments could produce extraordinary businesses over the coming decades. But successful technology and successful investments aren't always the same thing. That's an important difference. History reminds us that revolutionary innovations can transform the world while still producing periods of excessive optimism in financial markets. And that's exactly where we're headed next. Because once Tom looked backward instead of forward, he found a lesson every investor should understand before making their next investment decision. Let's go back to one of the biggest investing stories in recent history. In the late 1990s, the internet was changing everything. Businesses were rushing online. Investors believed a new era had begun. And in many ways, they were absolutely right. The internet did transform the global economy. But something else happened at the same time. Excitement started moving faster than reality. Companies with little revenue reached enormous valuations, simply because they were connected to the internet. Investors feared missing the next big winner, so money poured into almost anything associated with the trend. Eventually, expectations became impossible to meet. When confidence faded, stock prices collapsed. The Nasdaq Composite ultimately fell by roughly 78% from its peak to its lowest point during the dot-com crash. Many companies disappeared entirely. But here's the detail people often forget. The technology itself didn't fail. The internet became one of the greatest innovations in modern history. Some companies, including Amazon, survived that painful period and eventually became some of the world's most valuable businesses. The lesson wasn't that the internet was a bad idea. The lesson was that incredible technologies don't guarantee every investment will succeed, or that prices can't get ahead of reality. That's the parallel Tom couldn't ignore. Today's excitement centers on artificial intelligence. Once again, businesses are investing massive amounts of money into a technology expected to reshape the economy. Once again, investors are rewarding companies they believe will lead that transformation. And once again, nobody knows exactly how it will play out. Maybe today's leaders justify every expectation. Maybe new winners emerge. Maybe profits take much longer than investors expect. Nobody knows. That's why investing should never depend on correctly predicting a single future. Instead, Tom asked himself a different question. What if I'm asking the wrong question entirely? Instead of wondering which companies would dominate AI, maybe he should focus on building a portfolio that could succeed even if his predictions were wrong. That small shift changed everything. Rather than concentrating even more money into one country or one investment theme, Tom started thinking about reducing concentration risk. Here's the important distinction. Diversification cannot eliminate market risk. If global markets decline, diversified portfolios usually decline too. But diversification can reduce company-specific and country-specific risk. If one business struggles, another may perform well. If one industry slows, another may grow. If one country experiences weaker returns for several years, another may lead instead. History suggests leadership changes more often than people expect. At the beginning of the 20th century, the United Kingdom represented one of the world's dominant stock markets. Many investors assumed that leadership would continue indefinitely. It didn't. Decades later, Japan experienced an extraordinary economic boom. Its companies became global leaders in manufacturing and technology, and many believed Japan would permanently dominate world markets. That didn't happen either. Today, the United States occupies that leadership position. Its businesses have generated exceptional returns for investors over the past decade, but history doesn't promise that any country remains on top forever. That's why Tom stopped thinking in terms of choosing between America and the rest of the world. Instead, he asked, why not own both? That doesn't mean abandoning U.S. companies. Far from it. Many of the world's strongest businesses are headquartered there. The goal isn't replacing one bet with another. The goal is widening the opportunity set. Because outside the United States are thousands of companies operating across industries that the S&P 500 simply doesn't include. Global manufacturers, healthcare leaders, consumer brands, industrial businesses, semiconductor companies, financial institutions. Some will struggle, others may become tomorrow's market leaders. The point is that nobody can identify them with certainty decades in advance. By investing globally, Tom wasn't trying to outperform the S&P 500 next year. He was acknowledging something much simpler. The future is uncertain. And uncertainty is exactly why diversification exists. That realization also made him rethink something many investors chase without realizing it. Recency bias. We naturally assume whatever has worked recently will continue working. When one market produces strong returns year after year, it starts to feel permanent. But financial history tells a different story. Leadership rotates. Industries evolve. Economic conditions change. The companies dominating today's headlines may still be successful 20 years from now. Or entirely different businesses could emerge from technologies we haven't even imagined. Nobody rings a bell before those transitions happen. Which brings us to the final piece of Tom's strategy. Because changing how you diversify is only half the equation. The other half is making sure your own behavior doesn't become the biggest risk in your portfolio. That's where many investors lose far more money than they realize. Tom realized something surprising. The biggest threat to his long-term returns probably wasn't choosing the wrong index fund. It was making the wrong decision at the wrong moment. That's exactly what behavioral finance has found for years. When markets rise, investors become more confident. Many start believing recent winners will keep winning forever. Then the market falls. Confidence disappears. Fear takes over. And people who felt comfortable buying near the top suddenly feel desperate to sell near the bottom. Ironically, those emotional decisions often cause more damage than the market decline itself. Temporary losses become permanent because investors lock them in. That's why staying invested has historically produced better long-term outcomes than constantly trying to predict the next move. Tom wanted a portfolio that would make staying invested easier. For him, that meant building a strong foundation first. Most of his investments remained in broadly diversified funds. Those investments weren't designed to produce exciting headlines every week. They were designed to quietly compound over decades. Then, if he wanted additional exposure to individual companies or themes like artificial intelligence, he could do so with a much smaller portion of his portfolio. That way, one investment would never determine his financial future. This is an important distinction. Changing how you invest doesn't always mean changing what you invest in. Sometimes it simply means changing how much weight you give each idea. That's exactly how I now think about my own portfolio. I still believe the S&P 500 deserves a place in long-term investing. Its history, simplicity, and low costs remain incredibly compelling. But I no longer want my future to depend too heavily on one country, one group of companies, or one technological story, no matter how exciting that story may be. Instead, I'm gradually placing greater emphasis on global diversification. Not because I think America is declining, not because I think AI is overhyped, and certainly not because I'm trying to predict the next market crash. I'm doing it because I accept something every investor eventually learns. The future refuses to follow anyone's script. Nobody knows which country will lead markets 20 years from now. Nobody knows which companies will dominate the next generation of innovation. Nobody knows whether today's expectations are too optimistic, too pessimistic, or exactly right. The good news is that successful investing doesn't require perfect predictions. It requires a process that can survive uncertainty. For Tom, That mindset removed a surprising amount of pressure. He no longer felt responsible for identifying tomorrow's biggest winner. He simply focused on consistently owning productive businesses around the world while continuing to invest month after month. That may not sound exciting, but investing was never supposed to be exciting. It's supposed to be repeatable. Because wealth is rarely built from one brilliant decision. It's usually built from hundreds of disciplined ones. So if there's one idea I'd leave you with, it's this. Don't confuse confidence with certainty. It's perfectly reasonable to believe AI will transform the economy while also recognizing that markets can become concentrated. It's possible to appreciate the remarkable history of the S&P 500 while still asking whether your portfolio is diversified enough for the future. And it's possible to change your investment strategy without abandoning the principles that made it successful in the first place. That's why I'm changing how I invest before it's too late. Not because I know what's coming, but because I don't. And in investing, admitting what you don't know is often one of the smartest decisions you can make.